talk about why it is that yield curve inversion has such predictive value. Why do you believe that does? What does it mean in layman's terms?
Yeah, so there are many different ways to approach it. But in my dissertation, and actually you can think of the following type of mechanism, that people are worried about an impending slowdown. They go to the safest asset in the world, and that's the US Treasury bond, the 10-year bond. And what that does is it bids the price up, if people are buying, and that means that the yield goes down. So that's a simple way to think about it, and that's the sort of mechanism I talked about in my dissertation. It is a little different today because the yield curve indicator is so well known. So we're talking about it right now.
Yeah.
It is so well known that it also has a causal effect. And what I mean by that is when the indicator is really known, you see the yield curve is inverted, you're a CEO, and you're not going to bet the firm on like a new project that involves taking out a lot of debt. So why would you do that when it's like code red for a potential recession? You actually delay that project, and you might delay other spending decisions. You might make kind of strategic layoffs, 5 or 10% of your workforce, in preparation for a potential recession. And indeed, we've seen this. So last year in 2023, investment growth in GDP is composed of consumer spending, investment spending, government spending, and the trade sector. Investment spending was negative year over year. And this is just indicative of companies seeing the signal and reducing that spending. So what I mean by causal is that in itself, just seeing the inverted yield curve contributes to slower growth. And this is an important insight. You might think, well, that's bad. Well, it's actually good. So these companies are more prepared for a potential slowdown. And it means that if there is a slowdown, they survive. Like what you don't want in a slowdown is a company to take drastic action to slash employment. And as soon as you do that, when you get laid off, spend profile completely changes and we go into a spiral and the actual downturn is far worse.
What's
so it's
interesting
a trade-off of having some slower growth or potentially having bad recession. Nobody wants a bad recession.
It's interesting because what I think what you're saying is that the actual knowledge of that phenomena actually could precipitate the recession itself to a certain degree as well, right?
Or a slowdown, at least.
At least slowdown.
So it will slow growth as people engage in what I call risk management. And again, this is a trade-off. Are you willing to accept slower growth versus much more volatile downside?